All right. Good morning, Checkmate crew. It is 30 minutes after the opening bell of the New York Stock Exchange, 10 a.m. Eastern time on this. Today's Thursday, January 5th, 2023. Yours truly, Mickey Blindside here with your market memo. Okay, let's get right into it. Today we are seeing, I think we had some initial jobless claims come out. I don't really read into all of that stuff too much. The real non-farm payroll comes out tomorrow. I believe today was the jobless and the ADP numbers. For the most part, what I'm looking for is the bond market reaction to all of this. And, I look at TNX, and today it's up. So, perhaps it came out, I don't know, the labor market came out stronger than expected. Or, it doesn't even have to be that. It could just be the market's reaction to it. In the end, it doesn't really matter what the report says. It's what the market's reaction to it is. And this is, right now, TNX is up, so the 10-year yield is up. Bonds are coming down in price, so TLT is coming down. And then we have also the S&P 500, about 1% haircut for the day. So far, the VIX is up about 2.5%. VIX is still kind of in this range. I do want to see some big pops in the VIX. I think if we see some hedging demand coming back, that could really fuel that mini bull market thesis that we have. As the VIX goes up, generally, what we see is longer-term hedging happening as most institutions hedge 6 to 12 months out. If we see the VIX spike up, we could see all those puts being bought. And again, those bought puts, as they get cashed or as they decay, that is fuel for the market to rally. And we've talked about this multiple times. It has to deal with how market makers hedge and neutralize the delta in their books. Okay. One of the things I've been showing last couple of days is the S&P 500 cash index options open interest. We actually saw the open interest go up on certain strikes. Still, we have massive open interest here. The 155,000 here at the 4,000 puts, 172,000 on the calls. So this is definitely a huge zone, and we have big put walls all the way down. We're actually, a lot of these put walls are actually in the money. Now we're actually further below. I think on the S&P 500, we are on the S&P cash index. We're at 3817. Which means we're under now this 3850 put wall now. So we're getting close to this 3800 put wall. We have even further put walls all the way down. And so we are overhedged. I do think that a lot of institutions are hedging for the FOMC, and not only the FOMC, which happens on February 1st, but also the CPI report for next week. So just beginning of the year hedging. And these are a lot of these hedges were put on in the summer and in the fall. And if we see hedging demand coming back, we'll probably see, the June and the December expirations, getting a lot more volume in them as well. Okay, so we are hedged. If the VIX just suddenly drops, again, all these puts are going to get cashed out or they're going to decay very quickly. And so the market maker will have to buy the underlying to even out their delta. So the VIX will tell us the way. There's no need to guess about this, guys. We'll see it in the VIX. If the VIX drops heavily, again, it's just going to be fuel for a rally. We haven't seen that yet. The VIX is actually rising for the last few weeks. Maybe not this week because volumes are still relatively low. But in December, we started seeing, and end of November into December, we started seeing these outsized VIX spikes for these small drawdowns in the S&P 500. And again, this is something we've been anticipating since summertime, that as institutions have been buying lots of shares, through block purchases that we noticed back in the summer and in the fall, the demand for hedging is going back up again, okay? And so that's where the dollar, the US dollar topped out as well too. And we saw also some of our currency indicators, like the euro, the British pound, the Japanese yen, we all saw them coming down, or I'm sorry, going up, the dollar coming down in relation to those. So we saw those currencies going up as well too. And so that drove a lot of money into the stock market. And so again, there's this need for hedging, okay? All those dollars were traded in for shares, and so that's why we saw a topping of the dollar. That was one of our signs. Now because there's shares, institutions now need to hedge, okay? Most institutions, they don't like to sell in less than a year just because the profits that they make are taxed at a higher rate. So usually if we see a lot of dark pool, large block share purchases in the stock market, we usually see hedging demand going up within the next, let's say, 3 to 6 months, as institutions rather hedge rather than selling shares. Because if you hold it for more than a year, you get this lower tax rate. It's the capital gains tax rate rather than income tax. And so that does make a difference in fund managers' bonuses. We're seeing that hedging demand coming back. Again, I'd like to see the VIX spike up to like 26 or so. Okay, that will probably be a sign that we're seeing more of that 6-month to 12-month hedging happening. But again, we'll take it one day at a time. Anyway, the dollar today is making a move up today. It is now moving past this point. This was kind of our point where I said, this is a good place to start looking for a long for a retracement in this fall in the dollar. So we do have some UUP calls. UUP is the dollar index ETF. And I do have some calls as a hedge for my quad U shares. Right now, it seems as if we are, I haven't really checked yet. Yes, we're making a little profit now today. So those are up nicely. We shall see if, again, this is also the zones where I think we could see precious metals come down to attractive levels. And again, that's only if we see the dollar make a move up and retrace some of these losses. I don't think in this one move we're going to see highs again. I do think, though, we see higher highs in the dollar maybe in end of 2023, 2024. And again, I went over that thesis. You can go back to the last episode of 2022, which happened last week, and you can go through my thesis where I list, what I think, what I anticipate for 2023 and 2024. I'll also have links here. If you click top right corner on the exclamation point, I'll also have some links there as well too for you guys if you're looking at our YouTube recording. Okay, but the dollar, I do think it's coming back up. I don't think in this season we're going to get back to highs again. Again, maybe end of 2023, 2024, we might see that. But I do think we at least retrace a bit. And if we can retrace to this 107 to 109 zone, I think, again, precious metals, very attractive levels. Silver is coming down a bit today. Silver is coming back down a little bit down today. Gold also paring back just ever so slightly. About 1% or so. Compared to some of these moves we've been seeing like these 1-2% moves up in gold. So, a 1% down day, just one day, doesn't really get me all that excited. But I am excited if SILJ can come back down to these levels right here under $10. I'd be very excited about that. And you guys already know what my plans are for that. Speaking, we started this call with the S&P 500. Let's pivot back for a second. I do want to show some of our internal liquidity data and our internal market data. It's been, a good week or so since we've taken a look at this, and I think it's very important that we do on a regular basis. Our edge comes from this. It comes from knowing what the internal data is, and one of the things that I always like to look at is our junk bonds advanced decline line. It measures all the advances and subtracts the declining issues within the junk bond market. And I post this in our Discord every night, all for free, no paywalls, no subscription fees. I just post this in our Discord. So if you guys want to check, follow along with this on a daily basis, you might as well join our Discord. The links are in the description below. But this is what I posted earlier before the markets open. These numbers get updated once a day late at night on the FINRA website. And this is what we use to calculate our junk bonds advanced decline line. So right now we are actually seeing 2 days of advances in a row. If we see two more, that would be very interesting, because that would imply that this little dip right here in our junk bonds advanced decline line, that would make this a higher low. Okay. Now you and I, we've talked about this MOAB signal, MOAB, mother of all buy the dip signals. That just because the junk bonds ADL line makes this higher low is not the MOAB. The MOAB signal happens when we see a trend reversal in this junk bonds ADL line, but at the same time, we also see the New York Stock Exchange high-low line curl up above all of these moving averages, all right, the 20, the 9, and the 4 EMAs, also making a higher high, higher low trend reversal. So we need to see a trend reversal in both, in the junkiest part of the credit market, as well as more stocks making 52-week highs rather than 52-week lows. That's what the high-low line is how many stocks are making highs versus lows, okay? Right now, actually, it's a good point to make here. So back in June, I said that the Russell 2000, the small caps index, was getting stronger just because some of the worst performing small cap zombie stocks were removed. Not all of them, but some of them were removed from the Russell, and they were replaced with stronger components. Well, I think that's going to happen again this June. In June of 2023, the Russell will be even stronger index. I think they're going to get rid of stocks like Bed Bath and Beyond and AMC. For those of you who are degenerate gamblers, if you guys want to look at what's going on, I mean, these are just zombie stocks. I think Bed Bath & Beyond came out with some bad news that they might be insolvent at some point. I don't know. I don't really follow this stuff. Guys, I don't really... what I think about this kind of stuff. This is nonsense, but this is still in the Russell 2000, and I think these kind of companies are going to, they're going to leave. They're going to be out of the Russell 2000, and most likely they're also going to be companies like this, AMC, BBY, these zombie-like companies. They're also probably going to be taken out of the New York Stock Exchange composite and the NASDAQ as well too. And I think that's going to happen probably within the next 3 to 6 months, maybe even sooner, maybe in the time frame of like 3 or 4 months. But we might be seeing the New York Stock Exchange composite as well as the NASDAQ also strengthening as well too, getting more quality, getting rid of some of these zombie companies and putting more quality components in. And so that might be the impetus for the New York Stock Exchange high-low line to stop making all those new lows, okay? Because right now it's the junk, it's the really bad part of the market, like these zombie companies that are making lows right now. And so if those get replaced and we start getting, companies that are stronger in this, tighter credit market, that could be the impetus for us to see more highs than lows and this line to curl up. So the actual composite itself, the New York Stock Exchange composite and the NASDAQ could change in the next few months. That might be the impetus for this to go up. And if that is the case, if this starts curling up, junk bonds ADL line also starts making that a trend reversal, that together would be the MOAB signal. I always kept telling you guys that the MOAB signal is far away. It's nowhere near. I'm not saying that we're close, but I'm starting to see the light at the end of the tunnel. Okay, it's still I'd still say it's many weeks away. Okay, this is still many weeks away, but the MOAB signal. But I'm starting to anticipate this in the next couple of months, in the next few months, perhaps. Okay, of course, everything that we just talked about will have to transpire. It will have to continue in that trend. We will have to see all those junk components get out of the composites. We'll have to see this curl up. The junk bonds ADL line will still have to stay relatively secure, and it'll still have to curl up a bit. But if that continues, that would be the start of the MOAB signal. And again, that's still a few, at least a few weeks away, maybe even a couple months away. But again, I'm starting to see that light at the end of the tunnel. So we are getting closer. But again, still a few weeks away, in my opinion. Okay, so I just wanted to share that with you guys. Another thing that is interesting is that the New York advanced decline line, and this is the advanced decline line on the New York Stock Exchange, it is also starting to curl up as well. But today it is dropping a bit. If it can somehow reverse and go up in the next few sessions, that would be tailwinds for the Russell. When the New York advanced decline line is in an uptrend, generally small cap outperforms. And so if we start seeing this curling up and start making higher highs and higher lows, I mean, right now it appears as if that's a higher low, but we shall see. I mean, it could just be a blip, end of the year blip, and we could be making newer lows again. But again, I'm not trying to predict the future, just anticipating what could happen. But in the next few, if this turns around maybe today and also has a strong reading tomorrow, that could be a sign that we might start seeing some Russell 2000 small cap outperformance out of all the U.S. indices, and that would make things very interesting. If that were the case, I would be ready to start buying the dip, at least nibbling on some IWM longer term in the money calls, if that were the case. Okay, so it's still, I think, at least a few sessions away from confirming this, and even then I would want to see a dip before I buy. So this is something that's going to take time to manifest, at least a week or two, I suspect. But again, I'll let you guys know. And of course, on the Discord, I'll let you guys know live whenever I take a trade. So that's what I see. I wanted to go over that. So that is the market internals for the U.S. indices. Another thing I wanted to go over was I did place a new trade. I did get into Starbulk tankers. It got to our levels. I said if it gets under the 80-50 zone, that I will be wanting to start accumulating. So I put out some stink bids yesterday, not only on Starbulk, but also some of the other tanker names that we've been looking at. For example, STNG and all these other tanker names that we've talked about throughout the weeks. And I did put some stink bids, and one of them actually hit. And that was on Starbulk, and it was for the January 2025 18 calls. As you can see here, I bought these. I'm up a little bit just because when the stink bid went through, the implied volatility was at like 51 or 52%. Now the implied volatility on that chain is at 59%, and that's why right now I'm at about a 15% profit already, even though the price of the underlying went down. The implied volatility itself went up. And so again, when you trade options, you got to be right on three things. Okay, generally there's three factors you really have to consider. It's the direction, time, and volatility. Okay, and so even if you're wrong on one, you could be right on two, or wrong on two, right on one, and still make a profit. But there's a flip side to that as well too. You could be correct on two and be wrong on one and lose money. So it's a double-edged sword when it comes to options trading. But the right now I have 2 years on this. I have over 2 years on this, and again, once we see a little bit of pop in this, I will be selling poor man's covered calls. This one has weeklies actually, so I'll be a little bit more active in selling premium on something like this. as as we have weeklies. I can just roll covered calls on a weekly basis and collect premium that way. And again, I'll show you guys that in more detail. Hopefully you guys will learn the mechanics of that poor man's covered calls, and you could apply that to whatever stock ticker that you guys are interested in. Again, here, my focus here at Checkmate Trading is not an alert service. What I want to show you guys is I want to teach you guys how to fish rather than giving you fish, all right? So that you can feed yourself and you can, formulate your own strategies, and hopefully one day you can share those strategies with us and we can bounce some ideas as a community together, and that's what Checkmate Trading is all about. But I did want to let you guys know, Starbuck, I'm in. We're a little bit in a profit again because of the IV expansion in that options chain. Now we're in Starbuck and in FLNG. The Starbuck only got a partial fill, so I was going to double up from 0.5% to 1% on all maritime companies, but that's not the case here. I'm just shy of 1% on my allocation toward the maritime shippers. I did want to go all the way up to like 2 to 3%, so I still have ammo left over to get in on some of these other names if we see a bigger pullback. I wanted to, STNG was another one that I put some stink bids out there, but it didn't go through. So STNG is up today about 4%, but it did go down a lot, like I think over 10% yesterday. So, I think this is just a little bit of a retracement. The biggest losers yesterday are the ones that have a little bit of a gain today. But the ones that didn't lose as much are the ones that are underperforming today. So I think it's just a little bit of a mean reversion type thing within the maritime sector, just a little bit of rotation amongst different maritime companies. TRMD is another one that I put stink bids on, didn't get filled. The only one that filled again was the SBLK Star Bulk. This is a dry bulk shipper. By the way, if we're looking at dry bulk, we might as well be looking at the dry bulk, the Baltic Dry Index. The Baltic Dry Index actually yesterday poked down below a level that I didn't really want to see this low. I don't really want to see this low. I don't want this to close below this, on a weekly basis. I really wouldn't want to see this close below this level right here. Okay, which is 1082, which is still a ways away, but we've been seeing some big movements in the Baltic Dry Index. Ideally, I wouldn't want to see it below this week under 1189, okay, which was the low back in November. So I would want it to close above it. So let's see what happens today. Baltic Dry Index only updates once at the end of the day. So we'll see, okay? As far as the individual components for different shipping rates, like daily rates, this is today's daily rates, or yesterday's closing daily rates. One of the, silver linings is that most of the tanker spot rates are stabilizing. I mean, we've been seeing like big declines, like 5 to 10%, even double-digit declines, and so now we're seeing single-digit, except for the Aframax. For some reason, the Aframax went down 51%. Not really sure why. I have to look at some of the tanker deliveries to see if maybe there was a big delivery or something that caused the tanker rates to fall for Aframax, but I haven't checked that yet. And another thing is that so far also the LNG carrier rates didn't change much. Although LNG carrier rates don't really change on a day-to-day basis. Usually they'll change like once a week or so, maybe once or twice a week. So we'll see if the LNG tanker rates firm up a bit and maybe even reverse their downtrends starting from about November or so. That would put a lot of tailwind to our LNG carrier, FLNG, Flex LNG. Now, Flex LNG, I think LNG, I think the natural gas market, if you actually look at nat gas right now, we might as well take a look at nat gas. Natural gas has been on a little bit of a decline here just because of this warmer than expected weather. In the East Coast, I believe, they had a cold snap last week, but now we have above average temperatures in much of the United States, but except on the West Coast. On the West Coast, though, we have all this torrential rain and some big snowfall. In Europe, too, Europe right now has higher than expected temperatures. Right now, even in some of the ski resorts in Switzerland, they're reporting that there's a shortage of snow for the skiing season. So it looks like so far Europe has dodged a bullet as far as weather is concerned, and that is putting some pressure on the natural gas Henry Hub market. If we look at the TTF, which is the European nat gas market, we're also seeing similar, large declines. We're actually now at levels before the Russia invasion of Ukraine. Okay, so now we're getting to prices that we haven't seen since before the invasion. All right, there is talks of that we might even see too much natural gas in storage, which is very interesting because I believe the Germans, when they bought all this natural gas for storage, they bought it at the highs. Of course, they didn't really have a choice, because if they did have a cold snap, they would have put them in even greater danger. So they didn't really have a choice. I don't really blame them for buying at these high prices because they needed to, because also, the cold season was expected to be around the corner. But now that we're having this warmer than expected weather, now there's talk about, well, what do we do now with all this natural gas and storage? There might be too much. We'll see what happens. If there's too much, actually, I think a glut of natural gas would actually be a positive thing for FLNG, just because then the demand for storage for sea storage would go way up, and as contango increases in the natural gas futures market, that drives demand for traders to store their natural gas, wait for price to increase, and then sell it later on. Okay, so that demand for storage will go up as contango increases. Contango meaning the later dated months are priced higher than the front month, and we start seeing that around this April-May zone right here. April to May is when we start seeing some contango in the markets, and the contango really steepens as we get into the summer months. I do think that there is a chance that FLNG front months all that. So within the next few weeks, I think we see some upward movement in FLNG. Right now, we're just a little bit down on FLNG, but the mistake was I should have sold some covered calls and bought some protective puts right here as it spiked up after my initial purchase. I think we got in. We got in right here at the lows right here around that 33, under 33 and a half. And so right now, we'll see what happens. But I do think it recovers. And as the natural gas market goes into contango, I do think that the demand for that storage will go up, and we'll start seeing some. We'll probably start seeing those LNG container carrier rates on a daily basis go up too. All right. So that's the update on my positions. Okay. Anything else you guys want to look at? Anything you guys want me to take a look? Oh, somebody on YouTube chat. Do you still think bullish rally, which will be hated rally of this bear market, will start from February and stocks? I do think, here's the thing. Okay, so we talked about our tax selling thesis, right? We talked about this in December. In that first week of December, we started seeing semiconductors and some of the weakest performers sell off with the strongest performers, some of the oil and energy names. And so that was a huge tell for us that there was some tax selling going on. Also, too, around that same time, we also saw dark pool, the share of dark pool purchases or dark pool transactions on the stock market go down. So rather than, that average like 45 to 47%, we saw it dip down to 40%. And so more of the institutions were choosing lit exchanges, which means they were there was a higher demand to get out of a position. Usually that's what it means when we start seeing a higher share of the transaction happening on lit exchanges over dark exchanges. So all of that combined gave us the clue that this was tax loss selling. All right. Now, most institutions they will wait 31 days, after 30 days. So on the 31st day, they'll start buying back some of those shares that they sold, because that avoids a wash sale. So if they were to buy it within that 30 days, they don't get the tax benefit of that loss. All right, so they have to wait those 30 days, and that 30 days comes up around January 20th to 24th. Okay, that is when that's when I think, for some magical reason, the media will say, oh, for some reason, this is magic. We'll start seeing institutional bids come back into the market. Okay, we'll start seeing it come back. And I think it's going to come back with tech stocks first, because that's what got sold off with losses. And as big institutions rebalance and add more of the tech stocks that they sold off for tax loss selling, as they rotate back into that, I think that's going to cause some demand in the stock market. If also at the same time the dollar can't make a new high, I think a lot of that money that's in overseas dollar denominated accounts will also rotate into their home currencies, and we'll also see some risk on buying happening because of that. And again, those indicators are, I've talked about this for a while: GBP USD, the British pound. All right, the British pound. If we start seeing this, and if we see this make a higher low and then come back to make a higher high, that would be a good sign of that. Euro USD is another one. Japanese yen is the other. Okay, so these are the currencies that I'm looking at to see that risk on. That risk on sentiment, but and a lot of that also has to do with short-term interest rates, so ZF. So this will be an indicator for all those risk on currencies. So this will be an indicator of an indicator. Okay, so if we start seeing, again, so if we see this, and at the same time after that 30-day tax selling, on that January 20th to 24th, we also see institutional demand coming back, especially in the tech sector. Again, I think that could be a good sign that we see a mini bull market. This might be, again, if it happens, it will be one of the most hated, mini bull markets out there. Just like 2017, everybody thought it was magical that this rally was happening. Everybody was, said, oh, this is a false rally. It's a false rally. But then it just rallied for 8-9 months after that. I don't know if this one's going to last as long as that. I think it's going to last maybe a couple months, maybe a few months. And again, for that thesis, you can go back to the last episode of 2022. I'm going to have links. You can go through my thesis. I do think that we have a mini bull market in this longer secular bear market, okay? And these mini bull markets can last. I mean, they can last a few months. They can even last up to a year. Go back into the 90s, go back into the 70s. Some of these, longer secular bear markets had these mini bull markets that lasted a year or two even. So it's always possible, I do think that this is a multi-year secular bear market, but in between we'll have these mini bull markets, and I think one is setting up with a rolling mini bull market, where different sectors will be in a bull market, but some sectors won't be, and so we'll see this like low volatility churn or low volatility drift in the indices. I think until maybe the second half of 2023 into 2024. That's what I think so far. Again, from YouTube chat, 50 basis point probability is getting higher now on CME Group in February, so that might cancel the rally if CPI also misses this month. Yes, very possible. If CPI, right now, there's a big expectation for the CPI to come down lower. I think people are finally anticipating what we've been talking about since like April, May, June. I mean, we've been talking about this potential for a lower print around this time for like 6 months now when we saw commodities top out. I think all these CNBCers and all these media squawking heads, they're finally coming around to this. Better late than never, I guess. But yeah, it's very possible that we see that, especially, in the last couple of days, with all the Fed speakers that talked, on the media. They all mentioned that, they would like to see, interest rates higher for longer, and they might even raise. I think one Fed speaker said that he believes that the Fed funds rate, the top nominal rate, should be even higher than what other Fed speakers are expecting. So I think he said like 5.4, 5.5 or something like that. So if that's the case, yeah, we could see that happening. Actually, let's take a look at the Fed funds probabilities now that you mentioned it. For February, oh, look at that. It is increasing. Current rate is 450. So yeah, the chance of, wow. So within a week, it went from a 27% chance of a 50 basis point rate hike to a 45% chance, pretty much as a coin toss between 25 and 50. Interesting. Okay. So then what happens in May or in March? In March, we're still there, with an additional 25 basis point rate hike going up from 20% to 41% within a week. Okay, so we might see the chance of a 50 basis point rate hike in February and then a 25 basis point rate hike in March is looking like more and more of a possibility. 525, 525. So instead of 5 being the top nominal, 475, 5 being the top, it's not going to be 525. 525, and then we see a potential rate cut if that were the case in September. Okay. And another rate cut in December. Okay. So, all right. So, fine. So, it looks like the market is now gently pricing in a possibility of a higher nominal Fed funds rate for Q1, Q2 of 2023. Okay, because of the bad jobs data, it could be. I mean, the odds were, if you actually look at the odds were increasing for this from a week ago. So, I mean, yes, in one day, it also made a difference. Maybe that jobs report maybe made a difference. And again, the big jobs report is actually tomorrow. Tomorrow's non-farm payroll. But it looks like within the last week, the market has been pricing this in. So the bond market generally knows this ahead of time. Most people think that these data drops are very big. But if you actually look under the hood, if you look at currency markets and bond markets, they actually position themselves way ahead of time. Okay, so it looks like this is something that the bond market has been pricing in for the last week. Okay, not just in one day. Of course, some of it happened today, of course, but it looks like a lot of that happened within the course of a week. All right. Anything else you guys want to look at? Going once, going twice. All right, sold. And in that case, that will wrap up our session of the Morning Market Memo. Our Discord invitation link is in the video description below. Come join our Discord, be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I'll be back on next week, Tuesday, Wednesday, Thursday. 30 minutes after the opening bell in New York Stock Exchange, 10 a.m. Eastern time. Trade safe, guys, and I'll see you guys next week.